Hey guys, welcome to the Bitcoin Fortress podcast, helping you increase your financial freedom. This is episode 116, recorded here on May 19th, 2024. This podcast is for entertainment only and is not investing advice, so please do your own homework. Well, we got the usual rundown this week. We'll go through the market update and outlook quickly and then get into the top Bitcoin news. I do have something for the FUD of the week, a little article from Bitcoin Magazine on the Bitcoin Ponzi scheme paradox. And then we'll wrap up with this week's featured Substack post. And with that, we'll jump right in. Wall Street witnessed a record-breaking week, primarily driven by the latest consumer inflation data. On Wednesday, the headline Consumer Price Index for April increased at a slower than anticipated rate, while the core CPI cooled for the first time since October 2023. Following the data, markets were off to the races as investors ramped up their Federal Reserve interest rate cut bets. Positive sentiment pushed the benchmark S&P 500 above the 5,300 point level for the first time ever. The post-CPI euphoria stalled somewhat over the final 2 days of the week, but a stellar earnings report from Walmart was enough of a catalyst to push the venerable Dow Jones Industrial Average past 40,000 points on Thursday in a historic first. For the week, the S&P 500 added 1.5%, the blue chip Dow rose 1.2%, and the tech-heavy NASDAQ composite climbed 2.1%. Looking ahead, the spotlight next week will be garnered by NVIDIA. The chip giant and perceived leader of the artificial intelligence space is scheduled to announce fiscal first quarter earnings on Wednesday. Expectations are sky high, especially with the Jensen Huang-led firm having repeatedly delivered blowout quarterly reports showing massive demand for its AI chips. Its results will act as a barometer for the AI craze, and another strong performance could help Wall Street to new record highs. Wednesday will also see the release of the minutes of the Federal Reserve's April-May monetary policy meeting. However, market participants could receive comments on policy as early as tomorrow, with Fed Chair Jerome Powell set to deliver commencement remarks to Georgetown University Law Center via pre-recorded video. Additionally, investors will get quarterly reports from retail majors such as Macy's, Target, and Lowe's. All right, jumping into the top Bitcoin news of the week. First article from Bitcoin.com. This was posted yesterday. Blackrock Bitcoin ETF attracts 414 institutional holders. Analyst says IBIT blows away record. According to 13F filings with the U.S. Securities and Exchange Commission for the first quarter, 414 institutions have declared holdings in BlackRock's spot Bitcoin exchange-traded fund, the iShares Bitcoin Trust. The SEC requires institutional investment managers overseeing over $100 million in assets to file Form 13F to disclose their securities holdings. Bloomberg senior ETF analyst Eric Balchunas described this achievement as mind-boggling, noting that it blows away record. He emphasized that having even 20 holders for a newly launched ETF is highly rare. Other ETFs launched in January have not achieved nearly as many institutional holders as BlackRock's IBIT and several other spot Bitcoin ETFs such as Bitwise Bitcoin ETF, and the Fidelity Wise Origin Bitcoin Fund, and the ARK21 Shares Bitcoin ETF. The largest institutional holder of IBIT shares is Millennium Management LLC, which owns 20,859,447 shares valued at approximately $844 million as of March 31st. Schoenfeld Strategic Advisors LLC is the second largest institutional holder with 6,128,450 shares worth about $248 million. The U.S. State of Wisconsin Investment Board is the sixth largest institutional holder of IBIT with 2,450,400 shares valued at roughly $99 million. In comparison, Fidelity Wise Origin Bitcoin Fund has 235 institutional holders. Bitwise Bitcoin ETF has 98 institutional holders. And the ARC21 Shares Bitcoin ETF has 75 institutional holders. Notably, the Grayscale Bitcoin Trust has a lengthy list of 619 institutional holders. However, Grayscale converted GBTC from a Bitcoin Trust to a spot Bitcoin ETF in January, and many institutions already held GBTC prior to this conversion. As of May 16th, IBIT's Bitcoin holdings stood at 276,190 Bitcoin, valued at over $18 billion. Throughout the week, U.S. spot Bitcoin ETFs experienced daily inflows totaling $948.3 million. Grayscale's GBTC only saw a net daily outflow on May 14th, amounting to $50.9 million. In contrast, IBIT recorded inflows of $131.8 million. Fidelity's FBTC saw inflows of $344.5 million, and ARC's spot Bitcoin ETF received inflows of $243.7 million. BlackRock CEO Larry Fink stated in March that he is very bullish on the long-term viability of Bitcoin. The executive added that his firm's spot Bitcoin ETF is the fastest-growing ETF in the history of ETFs, emphasizing nothing has gained assets as fast as IBIT in the history of ETFs. So, good for adoption, but I don't think I'd want to be owning any ETFs if I could avoid it. Better to own your own keys, hold your own keys, and hold in cold storage. But still, it's good to see the adoption and obviously, the education that goes along with it. Next article, also from Bitcoin.com. This was posted yesterday. Russia and Iran collaborating on single BRICS currency, Iranian ambassador says. Iran and Russia are reportedly collaborating to establish a common currency for the BRICS economic bloc, TASS reported Thursday, quoting Iranian ambassador to Russia, Kazem Jalali. Speaking at the Russia Islamic World Kazan Forum 2024, which is being held from May 14th to 19th in Kazan, the Iranian ambassador highlighted the cooperation between Iran and Russia to establish a single BRICS currency. The forum aims to enhance trade, economic, scientific, technical, social, and cultural ties between Russian regions and the Organization of Islamic Cooperation countries and promote the development of Islamic financial institutions in Russia. Jalali emphasized Iran's active involvement in activities under Russia's BRICS chairmanship, working towards a single currency for the association. As a new BRICS member, Iran is significantly contributing to this effort, he stated, elaborating, the creation of a new single currency within the framework of the association is what Russia and Iran are working on. He also mentioned that the U.S. uses the dollar to impose sanctions, leading to the increased use of national currencies in mutual settlements. More than 60% of bilateral trade is in rubles and rials, Jalali said, adding that relations between Russia and Iran are currently at a golden stage. The BRICS economic bloc, Brazil, Russia, India, China, and South Africa, expanded its membership at last year's Leaders Summit, inviting Argentina, Egypt, Ethiopia, Iran, Saudi Arabia, and the United Arab Emirates to join. Many countries are now exploring settlements in national currencies instead of relying on the US dollar. Critics warn that weaponizing the US dollar, such as by seizing Russian assets, could jeopardize its status as the world's reserve currency. Iran has consistently supported creating a common BRICS currency. At a BRICS meeting in January, Iran advocated for a unified currency, while Russia and China focused on settlements and local currencies. Critics argue that a BRICS common currency could threaten the dominance of the US dollar. Rich Dad, Poor Dad author Robert Kiyosaki, for example, recently warned that a BRICS digital currency launch could lead to the collapse of the US dollar. The discussion of a common BRICS currency was widespread before the BRICS Leaders Summit in August last year, but it has since diminished. All right, next up from No Bullshit Bitcoin. This was posted on May 14th. Tornado Cash developer Alexey Pertsev sentenced to 64 months in prison in the Netherlands. A Dutch court convicted 31-year-old Alexey Pertsev of laundering $2.3 billion in cryptocurrency through the Tornado Cash mixer. Dutch prosecutors have alleged that Pertsev designed Tornado Cash to be the ideal money laundering tool through the use of smart contracts. Conversely, Pertsev's defenders argued that these same attributes made Tornado Cash such an effective privacy tool. The judges rejected Pertsev's argument that it was wrong to hold him accountable for Tornado Cash's users, who are, by design, anonymous and independent. Tornado Cash, in its nature and functioning, is a tool intended for criminals. The criminal user is fully facilitated, a judge reportedly said from the bench. Under the pretense of ideology, you did not care about the laws and regulations that apply to everyone and felt untouchable, he added. Tornado Cash's co-founder, Roman Storm, is facing similar charges in the United States. His trial is scheduled to take place in September. Despite the prosecution of the protocol developers, Tornado Cash continues to function independently and processes privacy transactions to this day, reports Wired. So, very interesting. They have a post here from Gigi from Noster. In other news, blacksmith sentenced to 48 months jail. His knife was used to stab someone. This follows the incarceration of an automobile manufacturer as one of his cars was used for a bank heist. Yeah, basically. It's pretty much garbage, but this is what Then They Fight You looks like, I guess. In other news, also from No Bullshit Bitcoin, this was posted on May 16th. IBEX Pay suspends services in the United States. So we have another service provider leaving the United States because of the crackdown. After careful consideration, it has been decided that effective 31st of May 2024, all IBEX Pay services in the U.S. will be suspended. Thank you for the support you have given us, and we hope to serve you in the future, announced IBEX Pay. This was not an easy decision to make, but after careful consideration, in light of recent events, we've concluded that this is the most appropriate choice for the current circumstances. A big thank you to all our U.S. customers for using our IBEX Pay product, and to Swan for being an incredible partner. We have loved working for you and with you, said CEO Jose Lemus. IBEX Pay continues to operate in all other locations, and our IBEX Hub service will continue to operate globally, he added. So the U.S. just keeps chasing away the entrepreneurs, and that's not a good thing. Also from No Bullshit Bitcoin, this was from May 17th. U.S. Senate votes to kill SEC Bitcoin accounting policy in a historical vote. In a 60 to 38 vote, the U.S. Senate joined the House of Representatives on Thursday in seeking to erase the controversial Securities and Exchange Commission Bitcoin and crypto policy known as Staff Accounting Bulletin number 121, which makes it prohibitively expensive for financial institutions to participate in the crypto custody. Even so, President Joe Biden has already vowed to veto the resolution. SAB 121 stipulates that a company holding a customer's crypto assets must record them on its own balance sheet, which could have significant capital implications for banks dealing with Bitcoin and crypto clients. Passing of the bill effectively enables highly regulated financial firms to offer custody services for Bitcoin. The SEC should never set policy over banks, no less, an industry they do not regulate through a staff accounting bulletin. This is nothing more than this administration attempting to skirt the law, Senator Cynthia Lummis from Wyoming said in a statement. But then Senator Elizabeth Warren voiced her objection to the vote on the Senate floor, arguing that it was inappropriate use of the Congressional Review Act. She's just not a fan. Previous week, the Biden administration issued a statement threatening to veto the resolution if it passes the Senate. So we know where they are at, and we'll just have to continue to watch and see how this unfolds. But I would imagine the banks would love to get into that business so they can make more money, and that would give Coinbase a little competition, which wouldn't be a bad thing, probably. But you should hold your own keys, and you shouldn't have to worry about a custodian. Next up from CoinDesk, this article was posted on May 17th. Crypto industry rallies behind House bill as it heads toward final vote. A wide swath of the crypto industry signed a letter to the top lawmakers in the U.S. House of Representatives explaining why they should get behind the Financial Innovation and Technology for the 21st Century Act. Well, that's a lot of words. As House lawmakers are poised for a floor vote next week on the bill, the letter says passage would help the U.S. keep up with global competitors. The U.S. House of Representatives is on the verge of a vote that will represent the closest the cryptocurrency industry has ever been toward finally winning regulation in the U.S., and the sector's associations and top businesses are encouraging House leaders to support the effort. Through the Crypto Council for Innovation, a coalition of digital assets organizations and companies, including Coinbase, Kraken, Andreessen Horowitz, the Digital Currency Group, and about 50 others, wrote a letter to Speaker of the House Mike Johnson and Minority Leader Hakeem Jeffries advocating for passage of the bill. The Financial Innovation and Technology for the 21st Century Act, or FIT21, has been authorized for floor time next week, where observers are hoping to see a midweek vote. The bill would set the Commodity Futures Trading Commission as a leading regulator of digital assets, and it sets out clear divisions for what the CFTC will handle and what would fall under the reach of the Securities and Exchange Commission. It would establish consumer protections, including rules around custody of customers' assets and their treatment in bankruptcy, and set up further guardrails against risky behavior. By passing this legislation, we can accelerate the growth of blockchain technology and digital assets, fostering financial inclusion and protecting national security, according to the letter. It is crucial for the U.S. to maintain its leadership in financial innovation. The crypto industry is on a high in Washington at the moment, having watched both the House and Senate easily pass a resolution overturning a crypto accounting policy from the SEC, though President Joe Biden vowed to veto the effort. That move to erase the SEC's Staff Accounting Bulletin 121 represented a fight that went decidedly in the industry's favor, drawing many supporters from the Democratic Party that's been more reticent than Republicans in backing crypto. For that accounting tussle, more than 1 in 5 Senate Democrats voted on the industry's side, including Majority Leader Chuck Schumer, and it was about 1 in 10 Democrats in the House. But the comprehensive legislation now approaching a House vote is of a much higher magnitude, and key Senate Democrats have so far seemed unprepared to match the House's effort. To date, the Senate has only shown a potential willingness to fit a different crypto bill, one regulating stablecoin issuers, into a package deal with other financial legislation. Representative Patrick McHenry The chairman of the House Financial Services Committee, where the bill was launched, said the level of Democratic support for FIT 21 in the House could be a major factor in whether the Senate is moved to action. When the measure cleared his committee, it did so with a handful of Democrats on board, despite opposition from their senior member, Representative Maxine Waters. So my take on this is, they're going to have to regulate crypto because, it's people are demanding it. The industry, quote unquote, is on board, but the devil is always in the details. And I guess as long as it continues to support private property rights and the ability for you to own your Bitcoin in your own self-custody, and doesn't outlaw that, and continues to support Bitcoin as private property with enforceable property rights, then I'd say all the other stuff is probably just about on ramps and off ramps and that sort of thing. I haven't read the legislation myself, but I'm sure more information will be coming out, and we can probably be talking about this some more as more details unfold. Next up from Bitcoin.com, this was just updated recently. Venezuelan authorities announced Bitcoin mining ban, confiscate over 11,000 miners to face the nation's energy crisis. So talk about taking the opposite approach to El Salvador, who we're going to talk about next. The Venezuelan National Power Ministry disclosed an operation to supervise the activities of high-power customers connected to the national power grid, including Bitcoin miners. On social media, the ministry stated that this plan aimed to disconnect all cryptocurrency mining farms in the country from the electrical system, avoiding the high impact on demand produced by these activities. Wow, that is just completely retarded. Because, I guess maybe Bitcoin mining's not okay, but what about AI? Data centers. Those consume huge amounts of power. Maybe they won't be unplugging those. Rafael Lacava, governor of the state of Carabobo, where a large part of the industrial complex of the country resides, led a series of actions that concluded in the seizure of over 11,000 ASICs and the disconnection of an undetermined number of cryptocurrency mining farms. The actions would focus on reducing the energy destined for these activities as the country faces constant blackouts derived from deficiencies in power generation due to several climate and sanctions-related challenges. Lacava stated miners couldn't keep their operations while the general population faced continuous energy interruptions. However, authorities did not clarify if these actions were definitive or if these would be applied just as the national electric system is adjusted to produce more energy. Governor Lacava declared that many more Bitcoin mining farms would be disconnected and that other measures, including a national executive order to reduce the energy consumption of state agencies, would be announced in the next few days. These actions offer insight into the cryptocurrency mining industry in Venezuela after the disconnection of several Bitcoin mining farms, when Sunacrypt, the national crypto watchdog, was linked to a corruption scheme involving the sale of sanctioned oil for cryptocurrency. Since then, Sunacrypt has been facing restructuring activities, and there's currently no clarity on the legality of the cryptocurrency mining activity in the country. The former president of Sunacrypt, Joselit Ramirez, and the former president of state-owned oil company PDVSA, Tarek El Assami, have been arrested and are currently under the custody of national authorities. Actually, Bitcoin incentivizes the development of stranded energy and the capture of stranded energy, and they could actually be leveraging Bitcoin to increase the amount of energy that's being generated in the country. So this is just completely and utterly retarded. But in other news, and this is from Crypto Potato, and this is posted on May 18th, articles entitled, "This is how much Bitcoin El Salvador has mined using volcanic energy," according to a report. Since 2021, when El Salvador began validating Bitcoin blocks with volcanic energy, the Central American country has mined 474 Bitcoin, worth approximately $29.6 million at current prices. According to a Reuters report, El Salvador mined the cryptocurrencies using a geothermal power plant fueled by the Tecapa volcano in the nation's east-central region. The energy generated from the Tecapa volcano is relatively small, but it powers 300 mining processors installed by El Salvador's Bitcoin-friendly president, Nayib Bukele. The nation dedicated 1.5 megawatts out of the 102 megawatts produced by the power plant to crypto mining. El Salvador's volcano-powered mining plant presents a sustainable alternative to the electricity-consuming operations of other Bitcoin mining entities, which have been criticized for their negative impacts on power grids and carbon emissions. Adding the 474 Bitcoin mined since 2021 to the number of Bitcoins El Salvador has purchased, the country now holds 5,750 Bitcoin, worth roughly $354 million at current prices. Interestingly, El Salvador's Bitcoin office revealed that several crypto mining entities, including Foundry USA, Antpool, ViaBTC, F2 Pool, and Binance Pool, joined the resources to win a reward for creating a blockchain that verified Bitcoin transactions validated by the geothermal power plant in the last 3 years. El Salvador has come a long way after becoming the first country to adopt Bitcoin as legal tender in 2021. From using renewable energy sources for mining to launching Bitcoin bonds and offering a citizenship by Bitcoin investment program, in mid-March, El Salvador's Bitcoin HODL strategy paid off with Bitcoin rallying above 70,000. The country began accumulating the digital asset in 2021 and announced in November of the following year that it would buy 1 Bitcoin every day. Bitcoin's value hovered around 16,000 at the time of the announcement. However, the asset was worth roughly 63,000 at the time of this writing. Crypto Potato reported that the country's stash saw a 55% return on investment, registering unrealized gains of about 66 million. Notably, the profits did not account for the nation's total Bitcoin holdings, as there were assets received through additional revenue streams unknown to the public. So that's how you do it. Go El Salvador. All right, next up in the FUD of the week is an article from Bitcoin Magazine, the Bitcoin Ponzi Scheme Paradox. Ponzi scheme has become a byword for all manner of financial frauds and monetary scams. When a rapid 6-month collapse erased $2 trillion from crypto market capitalization in 2022, mainstream media outlets were quick to again label cryptocurrencies, including Bitcoin, Ponzi schemes. Writing in the Chinese People's Daily online section, Shan Zhiguang and He Yifan, representing the Chinese blockchain-based services network, claimed, "Ever since Satoshi Nakamoto released Bitcoin, a peer-to-peer electronic cash system, in 2008, leading to the official birth of Bitcoin, the debate surrounding virtual currency, cryptocurrency, has never stopped for a moment. In its essence, the author believes that virtual currency is undoubtedly the largest Ponzi scheme in human history." Can Bitcoin be legitimately described as a Ponzi scheme? If so, is it really the largest Ponzi scheme in history? In the rapidly developing world of tokenized assets and digital currencies, the answer is not as straightforward as you might think. In fact, we are faced with a Bitcoin paradox. The Dictionary of Idiomatic English Phrases, published in 1891, claims that the etymological root of the phrase "rob Peter to pay Paul" meaning to take what rightfully belongs to one person to pay to another, is founded in English folklore. In 1540, the Abbey Church of St. Peter's, Westminster, was advanced to the dignity of a cathedral by letters patent. But 10 years later, it was joined to the Diocese of London again, and many of its estates appropriated to the repairs of St. Paul's Cathedral. There is some dispute and evidence suggesting rob Peter to pay Paul was in common usage before the 16th century. Later dictionary definitions specify that the phrase means transferring money from one group of people or place to another rather than providing extra money. If we apply this to bank deposits, which are bank liabilities, then bank borrowing represents a variation of the process. We could rephrase it, use the debt owed to Peter to lend to Paul. If we then consider a fractional reserve banking system and the likelihood that Paul's money will also be banked, then the whole deposit, lending, and debt creation process, we call it the fiat monetary system, starts to look distinctly fishy. The idea of taking money from some to pay others has enabled many frauds and scams over the centuries. If the prospective victims can be encouraged to forego pecuniary action, then the fraudsters are on to a winner, providing their fraud isn't exposed and they don't get caught. Sarah Howe opened the Ladies Deposit Company in 1879. Operating out of Boston, Howe offered her exclusively female clientele an enticing 8% monthly compound interest, promising to return $96 profit on an initial $100 deposit in the first year. In a highly misogynistic society where women's access to finance and banking was limited, Howe pitched her banking business by appealing to women's sense of injustice. Claiming effective charity status, she told unsuspecting depositors that she was bankrolled by wealthy Quakers and their deposits were safe. None of this was true. No one was covering Howe's operation. She was paying dividends to early investors directly from the deposits she had taken from other customers. Howe's fraud was exposed, and most of the women who believed her and in the cause she claimed to support either lost their savings or a considerable proportion of them. Howe served a 3-year sentence and upon her release embarked upon practically the same scam again before being imprisoned a second time. Howe's favored fraud would later become known as a Ponzi scheme. Less than two decades after Howe's downfall in 1898, William Miller, who became known to many as 520% Miller, started an investment scheme that promised investors a huge percentage return on their initial deposit. Aged just 21, by all accounts, Miller was a poverty-stricken office clerk with a young family to feed. Having failed miserably in his white-collar career with no notable blue-collar skills, Miller turned to the only thing he thought he could make money from: finance. Miller regularly frequented bucket shops, where those on lower incomes would effectively bet on activity in the stock and commodity markets. While in reality no stocks or commodities were exchanged, as a bucketeer, Miller studied market form like racing enthusiasts study horses. Miller was hopeless at this too, and regularly lost his meager earnings in the bucket shops. Miller somehow ingratiated himself among the flock of the Christian Endeavor Society of the Tompkins Avenue Congregational Church. He first convinced Oscar Bergstrom and two other churchgoers to invest what was then the not inconsiderable amount of $10 each into his insane financial proposition, promising them a 10% weekly dividend, an annual return of 520%. Miller convinced his victims that he was such an astute investor, he could not only indemnify their initial investment, but provide them easy riches in return. If they reinvested their weekly dividend, Miller was offering them compound interest that would ultimately provide a windfall of $1,420 for their initial $10 deposit in the first year. Anyone who understood either markets or finance would have quickly realized this was quite a ludicrous proposal. It seems Miller preyed upon people with a very limited grasp of finance. This is a common feature of nearly all Ponzi schemes. Miller's scheme took off because he seemingly delivered. His early depositors made the returns he promised. Within months, Miller's magic money making machine had become the talk of Brooklyn, then New York, and soon the entire United States, naming his scam the Franklin Syndicate. The money poured in from across the country. Unfortunately for most of his investors, it was all a ruse. Miller was paying dividends and cash outs from the money he had accumulated from every other investor. His gambit was to hedge that not all of his investors would cash out at the same time. While they didn't, providing withdrawals remained relatively low, he could cover the payments. You may have spotted that Miller's scheme was not dissimilar to fractional reserve banking in this regard. While the syndicate made some investments, there was no underlying portfolio that could even remotely cover any kind of run on Miller's operation. His entire scheme was based upon perpetual and significant deposit growth. A slowdown of incoming investors would leave Miller with an unsolvable liquidity crisis. The Franklin Syndicate was a fraud. When this was exposed in the press, Miller fled to Canada before being arrested and extradited back to the United States. Despite a protracted legal dispute involving successful appeals, which were then reversed, and a dizzying array of accusation and counter-accusation among the scam's protagonists, Miller, who was also nicknamed the Boy Napoleon of Finance, was nonetheless imprisoned in Sing Sing prison. Upon his release, Miller went straight and garnered yet another moniker, Honest Bill. While it seems highly likely, it isn't absolutely clear if Carlo Pietro Ponzi, better known as Charles Ponzi, was familiar with either Howe's or Miller's scams. What can be said is that he emulated their model of financial fraud and took it to new heights. Consequently, he will forever be remembered for his Ponzi scheme. Born in Lugo, Italy in 1882, Ponzi arrived practically penniless in Boston in 1903. By the time he embarked upon his Ponzi scheme, he had already been convicted for fraud in Canada and what we would today call people smuggling in the US. As a young man in Italy, Ponzi worked for the Postal Service. This perhaps influenced his decision to initially launch an entirely legal arbitrage business. Ponzi reportedly received a letter from Spain with an international reply coupon included. Ponzi noted that the IRC price paid in Spain was considerably less than the face value of the US stamp he could purchase with it. He set about exploiting the international price difference for legitimate profit by selling the foreign IRC purchased US stamps to US customers. Ponzi established the Securities Exchange Company for his venture. While theoretically viable, Ponzi's arbitrage profit margins relied upon him undercutting the U.S. Post Office. His potential customers could buy the stamps practically everywhere and had no inducement to buy from him otherwise. His margins were further restricted by unfavorable fluctuation in exchange rates, advertising costs, delivery and supply costs, and the required significant trade volume to provide himself with any kind of substantial income. In other words, if he was going to earn a living from his idea, hard work was necessary. Evidently, this wasn't something Ponzi was too keen on, and his ambitions went far beyond running a small business. Unlike Miller, who simply claimed he was a financial wizard, Ponzi recognized that he could lend some authenticity to his fraud by basing it upon what at least appeared to be a plausible business idea. Ponzi decided to make up some wild, unfounded claims about the success of his international arbitrage operation and focused upon attracting as many investors as possible. Claiming the need to maintain competitive advantage, Ponzi said he couldn't disclose the precise details of his method. A broad outline of his business plan was sufficient to convince a throng of investors. He offered them a 50% profit first within 90 days, and then later to increase the pace of incoming deposits within 45 days. Ponzi's scheme was, in all other respects, identical to Miller's and Howe's. Payments were made as promised to early investors from the deposits hoovered up from all the others. Healthy dividends paid to a minority convinced the majority to reinvest and never cash out, thus enabling Ponzi to rapidly expand, taking the bulk of his gains for himself. Ponzi knew where the real money lay and so sought to buy a controlling interest in a bank. Ponzi targeted the Hanover Trust Bank, which had turned down his $2,000 business loan request only a year earlier. Once the fraud was finally reported by the press in the summer of 1920, his Ponzi scheme collapsed in short order. Charles Ponzi's exposure elicited a terminal run on Hanover Trust, which also held a $125,000 deposit from the Commonwealth of Massachusetts, leading to the resignation of State Treasurer Fred Burrell. Ponzi's inexorable march towards another prison sentence probably wasn't helped when 520% Miller was quoted by the New York Times just days before the complete implosion of Ponzi's company saying, "I may be rather dense, but I cannot understand how Ponzi made so much money in so short a time." Ponzi faced 2 federal indictments on a total of 86 counts of mail fraud. He served 3.5 years of a 5-year term before being re-indicted for larceny by Massachusetts state prosecutors shortly after his release. Ponzi sued, claiming this was a breach of the plea bargain he had made with federal prosecutors. The effective double jeopardy argumentation went all the way to the Supreme Court, and Ponzi lost. In between his periods of subsequent incarceration, there were appeals, stints on the run, assumed fake identities, additional Ponzi schemes, and other frauds. Eventually, Ponzi was deported back to Italy in 1934. Ponzi was a flamboyant character who, despite his crimes, enjoyed some remaining popular support, which dwindled as his legal disputes dragged on. But his Ponzi schemes and frauds weren't victimless. Many people, especially in the Boston Italian community, lost their life savings to Ponzi. While accounts vary, the total estimated losses of the first named Ponzi scheme were between 15 million and 20 million, equivalent to between $231 million to $308 million today. Ponzi's wife, Rose Gianecco, stayed loyal to him throughout his undoing. When he was finally deported to Italy, Ponzi had reportedly swindled Rose and her family out of $16,000. In 2021, claiming Bitcoin was a Ponzi, the Brazilian computer scientist Jorge Stolfi defined the 5 primary characteristics of a Ponzi scheme. People invest into a Ponzi scheme primarily because they expect good profits, and 1. That expectation is sustained by such profits being paid to those who choose to cash out. However, 2. There is no external source of revenue for those payoffs. Instead, 3. The payoffs come entirely from new investment money, while 4. The operators take away a large portion of this money. Ponzi schemes are always too good to be true. A modicum of due diligence should deter those wary enough to exercise some. Regardless of Stolfi's arguments about Bitcoin, we'll examine them in more detail shortly. In order for a Ponzi scheme to succeed, in addition to a degree of financial gullibility, the investor falls prey to the fraudster because they expect good profits. So while there are victims, the individuals who lose their shirts aren't entirely blameless. They exhibit what former U.S. Federal Reserve Chairman Alan Greenspan called irrational exuberance. Obviously, this in no way exonerates the fraudster. That didn't stop Bernie Madoff, perhaps the most notorious exponent of the Ponzi scheme other than Ponzi himself, from leveling the accusation of greed at his victims. In March 2009, Madoff pleaded guilty to 11 federal charges, including money laundering and securities fraud, and was sentenced to 150 years. He died in prison in 2021, aged 82. Following his conviction, Madoff's family suffered a string of tragedies. In 2010, Bernie's son Mark committed suicide. In 2014, his other son Andrew died from a very rare form of cancer. And in 2022, Bernie's elderly sister Sandra Weiner and her husband Marvin both died in an apparent murder-suicide. It is frequently stated that Madoff operated the largest Ponzi scheme in history. For reasons we're about to discuss, that claim is dubious. Madoff served as Nasdaq's chairman in 1990, 1991, and 1993, and was arrested in 2008. By then, his Ponzi scheme had been running for at least 20 years, and prosecutors estimated the scale of his fraud based upon 4,800 known client accounts to be $65 billion. The total lost principal was finally estimated at $19.4 billion. Unusually, for a collapsed Ponzi scheme, nearly $15 billion of the principal has been recovered for some investors. The United States Securities Investor Protection Corporation protects investors against losses to fraud, but only if they unwittingly invested directly in the scam. Unfortunately, 80% Madoff's Ponzi scheme victims came from feeder funds or investment pools and were deemed third parties. As such, many of the relatively small investors were not eligible for SIPC protection. Larger depositors, such as institutional investors, were relatively well protected and have retrieved most of their investment, though not their profits. Those who withdrew more than they put in, net winners, were required to repay the difference. This left the vast majority of Madoff's small-time victims scrabbling to file civil action lawsuits to try to recoup lost savings. Once they were trying to access the protection fund repaid to the U.S. state by the very pools they had invested through, the big feeder funds themselves were largely covered by the SIPC. While Madoff maintained he was solely responsible, obviously such a monumental Ponzi scheme involved many players. In subsequent years, a few faced punishment. For example, Frank D. Pasquale, Madoff's chief financial officer, and Madoff's secretary, Annette Bongiorno, alongside his operations manager, Daniel Bonventre, and his accounts manager, Joanne Kruppe, all served time after related prosecutions. Others were more fortunate, financially speaking. The investor, Jeffrey Pickauer, had grabbed an estimated $7.2 billion from the Ponzi scheme. As with many others closely related to Madoff's fraud, he died unexpectedly shortly after Madoff's conviction. While his widow was subsequently compelled to forfeit the money, Pickauer certainly benefited in his own lifetime. Stanley Chase funneled his clients' investments into the Ponzi scheme for decades. Taking an estimated $1 billion in profits, he celebrated Israeli philanthropist finally settled a profit repayment of $277 million. Norman Levy had been investing in the Ponzi scheme since the 1970s. His estate settled for $220 million in 2010. Given the lengthy period of his involvement, this also seems like a rather favorable outcome. Madoff began his scheme with seed money from clothing entrepreneur Carl Shapiro. Shapiro had been investing with Madoff for 40 years and made a $250 million investment only weeks before the scam detonated. Shapiro paid back $625 million in total. Pickauer, Chase, Levy, and Shapiro eventually became known as the Big Four. Relatively speaking, their losses, if they had any, seemed more bearable than most. Madoff founded the Wall Street firm Bernard L. Madoff Investment Securities, LLC in 1960. Like Ponzi, Madoff's unique selling proposition didn't appear too outlandish. He went further than other Ponzi operators to scrupulously maintain plausibility. He gave his scam an air of exclusivity, initially declining would-be investors. He also cultivated his image as a trustworthy philanthropist, donating generously to worthy causes, and didn't offer obviously ridiculous returns. Claiming that he used a split-strike conversion or collar investment strategy, Madoff convinced prospective clients that by purchasing both out-of-the-money put options and selling call options, covered calls, he could assure a steady, low-risk 20% annual return on investment. If the stock value in Madoff's portfolio dropped, the purchase put option, forcing a sale at the subsequent above-market strike price, would mitigate any losses. If the price rose above the covered call strike price, Madoff's call option buyers would exercise their right to buy his stocks. While this would limit profits to the strike price of the covered call, the premium from selling the call options would also fund the purchase cost of the puts. Even for those with some grasp of market finance, it all seemed believable. Unlike Howe, Miller, and Ponzi, Madoff did not promise instant riches or make conspicuously exorbitant claims. This undoubtedly contributed to the longevity of his grift, but it wasn't the only reason he sustained the so-called largest Ponzi scheme in history for more than 2 decades. 16 years before Madoff's flim-flam was exposed, the Wall Street Journal reported The United States Securities and Exchange Commission's investigation of a Florida investment pool, run by the accountants Frank J. Avellino and Michael S. Bynes. The pair were suspected of swindling $440 million out of the Florida community through their A&B trading enterprise. But when the court-appointed auditors checked A&B's books, the money, at least, was all in place. Technically, the pair didn't appear to be defrauding anyone. Frank and Michael were taking a profit, effectively a substantial handling fee, after outsourcing their investment strategy to a money manager. That broker was Bernie Madoff. Madoff had pioneered electronic trading, calling it artificial intelligence. In 1992, as the SEC were investigating A&B, BMIS could execute trades faster and cheaper than anyone else. Consequently, BMIS's daily trade volume was around $740 million, representing 9% of all activity on the New York Stock Exchange. Despite many years during the 1980s when market volatility left money managers struggling to even match the turbulent performance of the S&P 500 index, BMIS were seemingly always able to beat it by some margin. When the Wall Street Journal quizzed Madoff about A&B's pool, he revealed that he had been operating his split strike and similar strategies such as convertible arbitrage since the late 1970s. In hindsight, suggesting something closer to a 40-year Ponzi scheme. A&B's mistake was not registering the trades with the SEC. Had they done so, then Madoff would necessarily have been listed as their broker. The SEC accused Frank and Michael of running an unregistered investment company that engaged in the unlawful sale of unregistered securities. Speaking about A&B, Madoff reportedly said he didn't know the money he was managing had been raised illegally. Everyone seemed happy to accept him at his word. For some reason, despite a lengthy investigation and court orders compelling the A&B to return investors' money, neither A&B's lawyers nor the SEC named Madoff. It was the Wall Street Journal that reported the identity of A&B's mysterious money man. Apparently, the revelation didn't even vaguely pique the SEC's interest in BMIS. Ironically, perhaps having read the Wall Street Journal article, following the closure of A&B and now knowing who the duo's broker was, nearly all of A&B's clients reinvested their money in BMIS's split strike squeeze, as did Frank Avellino and Michael Bynes. Madoff's Ponzi scheme had a better USP than any before it. It was a total charade nevertheless. Madoff was following the Ponzi method precisely. Madoff was simply depositing his investors' money in his account held by Chase Manhattan Bank, later merging into JP Morgan Chase, and paying client redemptions from those funds. The impact of the Ponzi scheme collapsed was devastating for some, but not everyone. At its peak, Madoff's account held $5.5 billion. The split strike conversion is a perfectly legitimate approach to investment. It's also a conservative long-term investing strategy, unlikely to deliver an annual 20% ROI. In the 1992 Wall Street Journal article, the journalist questioned Madoff about the apparent resounding success of BMIS. Madoff insists the returns were really nothing special given that the Standard & Poor's 500 stock index generated an average annual return of 16.3% between November 1982 and November 1992. I would be surprised if anybody thought that matching the S&P over 10 years was anything outstanding, he says. This was basically misinformation. Madoff claims split strike method didn't explain how he achieved such startling results. There's no evidence that the regulators, the supposed experts in financial fraud, were in the least bit skeptical. On the contrary, they appeared to be going to some length to avoid investigating Madoff. The 2008 financial crash was the main contributory factor for the collapse of BMIS. Like all Ponzi schemes, perpetual growth was a prerequisite. When depositors looking for safer havens cashed out, Madoff's reportedly faced a $7 billion liquidity crisis with no hope of resolving it. Madoff confessed to his sons, who were allegedly shocked by the discovery, and they turned their own father in after seeking legal advice. Madoff took a plea deal, supposedly to spare his family further pain. Sadly, that didn't pan out either. The SEC didn't take any serious interest in BMIS until 2008. The 2009 Office of Inspector General report into the string of SEC failures to investigate found nothing untoward. The fact that SEC Assistant Director Eric Swanson was closely linked to the Madoff family in a relationship with Bernie's niece was not deemed suspicious. Shanna Madoff just happened to be Madoff's chief compliance officer, having met in 2003. She and Swanson married in 2007. Going back to the A&B investigation, between 1992 and 2008, the SEC received 6 substantive complaints and had read 2 media articles from reputable publications, the Wall Street Journal's piece being one of them, that raised some red flags with regard to Madoff's unusually consistent returns. Determining that throughout the 16-year period of red flags, the SEC never took the necessary and basic steps to determine if Madoff was misrepresenting his trading, and that the SEC could have uncovered the Ponzi scheme well before Madoff confessed, the OIG found no evidence of any wrongdoing. Apparently, it was all due to the SEC trusting whatever Madoff told them. The involvement of too many inexperienced personnel who were presumably clueless was reportedly a problem. A general lack of planning, as is monotonously usual for this kind of internal investigation, a systematic breakdown for which no senior level officials held any sort of responsibility, all contributed to SEC's alleged failure. Remarkably, the OIG stated the SEC examiners and investigator failed to understand the complexities of Madoff's trading and the importance of verifying his returns with independent third parties. Which rather begs the question what the SEC supposedly does if it can't understand the complexities of financial market trading. But are there any other reasons why the SEC may have been averse to upending BMIS? BMIS was a major third market trading provider. It was acting as a market maker, providing liquidity to finance the over-the-counter trade in securities between large institutional investors. While these securities are exchange listed, they are not traded through the big stock exchanges such as the New York Stock Exchange. The third market provides a level of anonymity and excludes some public information normally required for trading on the major exchanges. It is where big institutional investors go to conduct quick business, typically buying and selling large blocks of company shares. They use the third market for their own benefit rather than acting on a client's behalf. BMIS was one of the largest, many say the largest, market maker on Wall Street. As such, BMIS might, for example, buy a large block of shares off a major investor for cash, thus enabling large institutional investors to quickly liquidate significant stock holdings without needing to finalize a buyer. As noted by the Dubai-based investment incubator Faster Capital, third market players play a crucial role in enhancing market liquidity by providing a constant stream of buy and sell orders. Their presence ensures that there is always a counterparty available for traders regardless of the prevailing market conditions. By doing so, they help stabilize the market and ensure that trading can continue even in turbulent times. Madoff's Ponzi scheme was a vital source of liquidity for global financial markets. Apparently, this had nothing to do with the SEC's peculiar Madoff blind spot. We are asked to believe that U.S. regulators were oblivious to an enormous Ponzi scheme run by one of Wall Street's leading firms for more than 20 years. BMIS' key role in shoring up unsteady global markets has nothing to do with it, or so we're told. When it all came crashing down, Bernie Madoff's $7 billion liquidity trap was nothing compared to the hole the rest of the financial system found itself in. When researchers from the University of Louisiana at Lafayette looked into Madoff's Ponzi scheme bank account, they reported, assuming that the deposits returned the bank's net interest margin and grew at a random geometric rate, this paper estimates that JP Morgan Chase generated $435 million in after-tax profits from this very large account over the course of 16 years. Eventually, JP Morgan Chase agreed to pay the U.S. government a $2.6 billion settlement for a deferred prosecution agreement and admitted negligence. Subsequently, JPMC were able to resist a lawsuit from the net winners of Madoff's schemes, who accused JP Morgan of direct complicity. The judge cited JPMC's admitted negligence in his ruling, observing that negligence did not amount to fraud. The investors not covered by the SPIC lost again. Like everyone else with oversight of Madoff's activities, JPMC maintained it didn't have a clue, although conceded it could have been more diligent. For major commercial banks like JPMC, $2.6 billion isn't chicken feed, but nor is it backbreaking. Immediately following the 2008 financial crash caused by the wild speculation in the financial derivatives market, the U.S. government agreed to inject $250 billion of capital into the commercial banks. This was in addition to the $700 billion purchase of the bank's junk assets and a senior debt underwriting package worth $1.5 trillion, including $500 billion deposit assurance for business accounts. This amounted to an initial $2.45 trillion bank rescue mission in the U.S. alone. We'll stay focused on the U.S. here, but we shouldn't forget that what happened in the U.S. was emulated in many nations. The story behind the global 2007-8 crash is well known, but worth briefly reiterating. Mortgage-backed securities are securities traded in the derivatives market. An MBS is a fixed income security based upon interest payments due on the pooled mortgages it contains. The underlying assets of an MBS is the accumulated bundle of mortgage agreements. The early to mid-2000s saw rapid property price increases in the U.S. combined with plummeting Fed fund interest rates that stayed relatively low until mid-decade. The commercial banks were throwing money at anyone who claimed they could afford to make the repayments. This included lending to the subprime market, catering for people with low credit scores. Often these were interest-only mortgages and not just household mortgages either. Collateral loans on commercial, industrial, and agricultural property were often pooled with residential mortgages and MBS. Subprime lending to house buyers setting higher mortgage rates was particularly lucrative. If the borrowers defaulted, the banks could repossess, make the family homeless, and sit on tidy property portfolios, as long as the housing market remained buoyant. The minimally regulated investment banks were operating hedge funds, trading MBS, and other securities in the derivatives markets. Thus, as commercial banks also operated investment arms, they were increasing demand for their own mortgage lending. They were inflating the housing bubble and stimulating their own high-risk subprime lending. The ratings agencies, who have a conflict of interest because they are paid by the banks, gave nearly all the MBS AAA ratings, including MBS stuffed with subprime mortgages. Consequently, institutional investors were eager to trade supposedly safe residential mortgage-backed securities. This trade was again fueled by the commercial banks, who continued to imprudently shower cheap money on investors enthusiastically speculating with MBS. Trade was done over the counter, ably assisted by, among others, Bernie Madoff, who offered institutional investors additional liquidity whenever they wanted to pounce on an MBS opportunity. To complicate matters, other financial derivatives based solely or largely upon MBS, such as collateralized mortgage obligations and collateralized debt obligations, were also being liberally traded. Stoking things further, the commercial banks have been selling credit default swaps to mitigate potential MBS risks for years. CDS buyers generally pay a regular premium to the seller in exchange for a purchase agreement of the security and interest due. If a credit event occurs, a credit event for an MBS would be triggered if the mortgage holders defaulted. What's more, the CDS are also derivatives that can be traded. Many institutional MBS investors bought CDS from commercial banks or other sellers and then resold the CDS to other investors for marginal profit in the derivatives market. The CDS model of insurance cover for MBS speculation encouraged the rating agencies to issue AAAs on MBS with very limited scrutiny of the underlying assets, the subprime mortgages. So immense was subsequent derivative trading in CDS, by 2007, CDS constituted the largest single asset pool in the world. The estimated global CDS pool value was $62.2 trillion. What happened next would wipe 35.9 trillion of CDS value off the financial markets in 2 years. Starting in 2004, the Fed fund rate began to rise. This corresponded with the end of many subprime borrowers' initial mortgage agreements. As they looked to remortgage, they couldn't meet the new rates, and mortgage delinquency, defaults, repossessions, and household debt rose sharply. The U.S. housing bubble popped, resulting in widespread economic pain and years of austerity. As with the demise of Madoff's Ponzi scheme, some investors fared remarkably better than others. As usual, it was the small-time depositors, homeowners, and the public who bore the brunt of the financial misery. In all likelihood, the precursor to global financial collapse wasn't as bad as many feared. Subprime mortgages were the underlying assets in a relatively small percentage of MBS. The real problem, once again, was the complexity of the derivatives market. When the music stopped, the interweaving network of MBS, CMOs, CDOs, and CBS, combined with the relative anonymity of OTC trading, left investors, banks, and regulators alike unable to identify where the exposure lay. No one could figure out who was holding junk bonds and who wasn't. Consequently, as demand simply stopped, the investment banks were left holding mountains of toxic assets. While the reason to panic was perhaps not as acute as assumed, panic ensued nonetheless. The global derivatives market is almost entirely dependent upon investor confidence. Without it, regardless of their notional value, the multitude of MBS-related financial instruments were relatively worthless. Taking the knock-on financial impacts into account, the final cost of all this, just to the U.S. economy, was practically incalculable. According to Harvard Business Review, in 2018, a reasonable total loss estimate was somewhere in the region of $4.6 trillion. As conservatively estimated by the Federal Reserve, this effectively meant that every U.S. citizen paid $70,000 into the derivatives scam. The cost of the bank bailouts alone forced every U.S. tax-paying citizen to become an investor, whether they wanted to be or not. So let's review how a truly gargantuan Ponzi scheme operates. If done with any aplomb, the USP seems plausible. This attracts a multitude of investors who think they're investing in a real financial plan. In reality, the underlying assets are junk, and they're actually receiving payments from everyone else invested in the scheme. That is exactly how the 2008 derivatives market financial scam played out. So no, Bernie Madoff's Ponzi scheme wasn't even close to being the largest Ponzi scheme in history. It was a bit player in the colossal global financial fraud that dwarfed it. But this still wasn't the largest Ponzi scheme in history. As noted in the 2011 crisis report, the 2008, the notional amount of money invested in OTC derivatives was $673 trillion. US GDP in 2008 was around $14.5 trillion. Global GDP in the same year was about $61 trillion. How could anything on the planet have a notional monetary value more than 10 times larger than the monetary value of the entire productive economy of the Earth? The answer is that the global fiat currency monetary system is the mother of all Ponzi schemes. All of us invest in it with our labor, but there's no intrinsic value underpinning that currency. Thus, its supply can expand without limit, making it seemingly possible to notionally value a tranche of derivatives far beyond the value of the entire global economy. Via such mechanisms as inflation, the early investors, those who first grabbed the issuance of new money, the commercial banks, cash out thanks to a transfer of wealth from all of us to them. As demonstrated by Professor Richard Werner in his 2014 paper titled "Can Banks Individually Create Money Out of Nothing?" Banks create fiat currency from nowhere whenever they make a loan. Some will argue that fractional reserve banking limits this process. The problem with this is that central banks create reserves in exactly the same manner. So, for example, according to the Bank of England, quantitative easing, which pushed the global monetary supply to literally climb off the charts. This new digital money didn't exist until the central bank made it appear with a wave of its financial wand. Just as the commercial banks conjure broad money from nothing, the central banks create the same fairy dust, as Werner called it, when they create magic reserves or base money out of the ether. The Bank of England adds that they also use this new money to buy bonds from the private sector. Imagining money into existence simultaneously creates reciprocal debt. Asset values certainly increased prior to the collapse of the 2008 global Ponzi scheme. Not only was the assumed value speculative to the point of being baseless, the purchases were made with fairy dust. All of this manufactured debt and the profits that a select few glean from it is ultimately paid by us, the taxpayers. We are unwitting investors as savers. Small businesses and working families lose purchasing power. Household debt accrues. Aided by ever-escalating national debt ceilings, the institutional investors and the banks, as industry partners of government, just keep going. There is nothing real about the global economy system Ponzi scheme. While supply and demand and basic economic principles like value still apply, the financial system outstripped the real economy and headed off to Neverland half a century ago. Following the 2008 financial crash, they largely caused the commercial banks continued to plow their taxpayer underwritten fairy dust into the derivatives market, generating ever more nymph-fueled debt in the real global economy and hoovering up more profits along the way. Between Q3 2008 to Q3 2010, major U.S. banks increased their total notional derivatives exposure from approximately $175 trillion to nearly $235 trillion. No one really knows how big the notional value of the current derivatives market is. Some say it's more than $1 quadrillion. In Ponzi scheme terms, this is tantamount to saying the collapse of the derivatives market would leave a nominal debt owed hole in the global economy of $632 trillion. The principal risk is $18.3 trillion. To be frank, precise calculations of the scale of derivative funny money speculation are somewhat irrelevant. Suffice to say, there are monstrous sums sloshing around in high-risk derivative Ponzi schemes that can only exist thanks to debt-based money printing, usury, in other words. If investors lose confidence and try to cash out of the derivatives market, the whole house of cards will crash. It will take everything with it again. Of course, hedge fund profits are also paid in magic money, but that doesn't matter to the grifters. As long as we all carry on believing the so-called money is real, we will continue to traipse off to work to pay for it, thereby allowing the profiteers to convert their sparkles into real assets. Mansions, yachts, huge tracts of farmland, weapons factories, gold, and Bitcoin, for example. Satoshi Nakamoto's began work on Bitcoin in 2007, before the global financial crash took shape. That said, to a great extent, whoever the pseudonymous Nakamoto may be, they nevertheless offered a potential solution to a fiat monetary Ponzi scheme. The cypherpunks have been working on the financial sovereignty problem for nearly 2 decades prior to the publication of Nakamoto's white paper. They were wrestling with complex cryptographic problems like how to independently timestamp transactions on an electronic ledger and how to overcome the problem of double spending. Using the same unit of digital currency repeatedly without reliance upon some third party verifying transactions. The cypherpunks were trying to cut out the banks. Building on the earlier work of the cypherpunks, like David Chaum, Nakamoto's elegant distributed ledger technology solution was truly unprecedented, something new under the sun. Bitcoin is a peer-to-peer electronic currency issued and signed via cryptographic algorithms. Cryptocurrencies are separate and distinct from other forms of digital currency. The network of nodes accept proof-of-work consensus rules to validate and broadcast transactions on the network. The nodes are widely distributed, each carrying a complete record of the network's transaction history. They do not require permission to validate proof-of-work on the network. Bitcoin is a P2P cryptocurrency that operates on a decentralized permissionless blockchain. This means it can be used by people around the world to make international remittances without the need for any third party such as a bank or payment service provider. All they need is internet access. If we take Bitcoin to be a functioning currency, a medium of exchange for goods and services, and if we also accept Satoshi Nakamoto's vision of decentralized peer-to-peer permissionless network ledger, Can Bitcoin legitimately be called a Ponzi scheme? Let's revisit Jorge Stolfi's Ponzi scheme definition. You can invest in Bitcoin expecting good profits, but only if your intention is to trade it and not use it as a currency. As a currency, there are no trade profits to cash out. You earn it and you spend it as you would with any other medium of exchange. One of the criticisms of Bitcoin and other cryptocurrencies is their valuation volatility measured in fiat currencies such as the US dollar. Certainly, if you bought enough Bitcoin in 2009 and cashed out today, you would have made a striking above inflation profit, but that all depends upon the intrinsic value of Bitcoin. In a Ponzi scheme, there is no external source of revenue to cover payoffs. But this is a moot point with regard to Bitcoin. Bitcoin doesn't need external sources because it is a currency with intrinsic value and there are no payoffs unless you're trading it. Any payoffs traders take are usually paid in fiat currency. While the traded Bitcoin needs a buyer, no Bitcoin is actually removed from the P2P network. To this extent, there is no new investment money, merely a transfer of ownership of the existing currency. Price fluctuation is a reflection of Bitcoin's intrinsic value. This may be altered up or down by trader activity, but it is not a function of Bitcoin. It is a consequence of trading Bitcoin as one might on the foreign currency exchanges. Traders gather fiat fairy dust by trading Bitcoin between themselves. No one is taking large positions in Bitcoin away. Bitcoin mining using computers to verifying proof of work is time and effort paid in Bitcoin. Bitcoin is not a Ponzi scheme. It is a currency. Unlike fiat currency fairy dust, it is not created out of nothing. Real work, Bitcoin mining, earns Bitcoin and adds it to the blockchain. Satoshi established Bitcoin in 2008, the same year the global financial crash took hold. Nakamoto limited the total maximum supply of Bitcoin to 21 million Bitcoin. There is a lot of debate about why the 21 million figure was set. Some say it is a mathematical function of the Bitcoin protocol, others that the intention was to create scarcity and thus render Bitcoin a store of value. Consequently, people sometimes refer to it as Bitcoin gold. Mediums of exchange are only worth whatever value we place on the goods and services we can buy with them. In 2024, goods and services that cost 130 pounds sterling could have been purchased for $10 in 1970. This is a product of inflation, which literally means inflating the money supply, and represent a massive erosion of purchasing power. Fiat fairy dust is an appalling store of value with seemingly unlimited magical supply. Its depreciation is phenomenal. The current fiat currency-based monetary system concentrates wealth and ultimately political authority in the hands of those invested with the mystical power to create money out of nothing. The central and commercial banks, Bitcoin, or more specifically the DLT it is based upon, offers the world the possibility not just of a new monetary system, but of a new economic paradigm, decentralized finance. When the money printing presses are controlled by a select few, they can gatekeep who enters in the marketplace and who doesn't. They pick the winners and losers and have consequently constructed a global public-private partnership designed to consolidate their network's global power and influence. Decentralized and permissionless-based DeFi defies G3P power. For example, by putting up your Bitcoin as collateral, you can create a smart contract to locate funds pooled on the DLT to raise investment capital without any recourse to a third party, such as a bank. While such DeFi is currently nascent and unrefined financial technology, presently high risk, the potential to stimulate entrepreneurship, scientific and medical research, and much more, absent any centralized control, could benefit humanity greatly. If Bitcoin is to be scaled as a functional global currency, then the layer 2 blockchain solutions such as the Lightning Network are an unavoidable necessity. This does not mean that Bitcoin cannot remain a permissionless, decentralized currency, but it increases the chance of centralization and control. While the Bitcoin community battles to ensure that doesn't happen, it is under attack from off-chain actors. They view Bitcoin as a tantalizing USP for their beloved fiat Ponzi scheme. Returning to the observations of Shan Jingquang and He Yifan, they suggest that the Ponzi scheme can be extended beyond the fraudulent accumulation of currency. Now imagine if instead of basing your Ponzi scheme on equities, you create a security that tracks the performance of an underlying asset that you can trade many times a day. Then you offer investors an equity-type Ponzi scheme using this USP. A Bitcoin exchange-traded fund would seemingly fit the bill. A few weeks ago, the US SEC approved spot Bitcoin ETFs. BlackRock responded immediately and publicized its iShares Bitcoin Trust. BlackRock chairman Larry Fink was understandably effusive about IBIT. Speaking to CNBC shortly after the SEC decision, he laid out what he had in mind. BlackRock has been earnestly pursuing ETF opportunities since its pivotal 2009 acquisition of Barclays Global Investors. Nonetheless, given its architectural transformation, SEC regulatory approval was very fortuitous for BlackRock. Luckily, the independent SEC made the right choice at the right time for BlackRock. How can the fiat currency Ponzi scheme have survived for so long without being exposed? Why haven't populations rebelled against the inflationary wealth transfer from them, what we might call a financial parasite class? As pointed out by Mark Goodwin, the birth of the Bitcoin dollar by effectively tying the world's leading reserve currency, the US dollar, to oil prices and then making often violent maneuvers to largely control oil production and the energy market, the US dollar and its economy enjoyed what former French President Valéry Giscard d'Estaing called an exorbitant privilege. Foreign governments' need for dollars allowed the US monetary Ponzi scheme and thus the world's to continually expand. There was a constant stream of new investors. Sure, the effect was to push national sovereign debt beyond the point where, for instance, the US economy can pay it, but it didn't matter as long as the investors kept rolling in. It's a Ponzi scheme, not a real monetary system. But all things too good to be true come to an end. The global commitment to sustainable development, shifting the global debt-based economy's underlying asset from oil to carbon, and the rise of the multipolar world order, shortening supply chains and redistributing global energy flows, has added pressure to the dollar reserve system. But the grifters aren't willing to simply give up on their fiat Ponzi scheme. They are instead constructing a global synthetic fraud. Bitcoin evidently has a significant role to play in their schemes. Is it Bitcoin's potential as a store of value that raised the likelihood of it becoming the basis of the new or ongoing fiat Ponzi scheme? Now, through its Bitcoin ETF scam, the parasite class is shifting to Bitcoin as the new gold, a virtual gold standard, if you like. There is a Bitcoin Ponzi scheme paradox. While Bitcoin is not a Ponzi scheme exploited as a commodity, it is fast being transformed into the claimed basis for the continuance of the largest Ponzi scheme in history, the fiat currency monetary system. The vast majority in the Bitcoin community want to see Satoshi's vision realized. Unfortunately, such egalitarian aspirations are something else global investment institutions like BlackRock don't care about. Wow, that was a lot longer than I thought it was going to be, but it was a really interesting piece, and hopefully you enjoyed that. And finally, from Bitcoin News, Bitcoin's bullish momentum. It has a lot of room to run. This was posted on May 19th. Bitcoin has been on a notable upward trajectory lately. Bitcoin analyst Willy Woo believes that Bitcoin has significant potential for further upside price growth, highlighting key indicators that suggest a bullish trend. One of the primary tools Woo uses to predict Bitcoin's future is the volume-weighted average price oscillator. Woo's insights, along with various market data, point to a promising future for the digital asset. This technical indicator provides a nuanced view of price movements by considering the volume of transactions at each price level. Essentially, gives more importance to prices with higher trading volumes, offering a balanced perspective on market trends. In a series of posts on social media platform X, Wu explained the significance of the VWAP oscillator. He highlighted that it tracks the ratio between Bitcoin's current price and its VWAP oscillating around a 0 point. When the oscillator is in negative territory but starts moving upward, it often signals the beginning of a bullish phase for Bitcoin. Recent trends show the VWAP oscillator has been negative for months but is now rising. If this continues, it may soon hit neutral, indicating a potential market shift. This pattern suggests that Bitcoin might experience further gains until the oscillator peaks in positive territory and then starts to decline. Another factor contributing to Bitcoin's positive outlook is the surge in retail investment. According to data from CryptoQuant, retail investors have purchased approximately 135.7 million worth of Bitcoin over the past month. This influx of capital from individual investors is a strong indicator of growing confidence in the Bitcoin market. Technical analysis of Bitcoin's price charts also supports the bullish outlook. On the 4-hour time frame, Bitcoin has formed promising patterns such as the bullish abandoned baby and bullish engulfing candlestick. These technical indicators typically signal a continuation of upward momentum. Other than these, analyst CryptoJeb highlighted another bullish pattern known as inverse head and shoulders. This pattern, combined with other indicators like the moving average, convergence, divergence, or MACD, points to a strong potential for Bitcoin's price to reach new highs. Jeb stated that this pattern could propel Bitcoin's price to 100,000. Another analyst noted that Bitcoin's current price movement closely resembles its 2020 post-halving trend, suggesting a potential takeoff if the pattern continues. Furthermore, Wu mentioned that Bitcoin is still in the early stages of its liquidity cycle and is undergoing a very healthy reset against a backdrop of increasing capital flows. This indicates that Bitcoin is building a solid foundation for its next leg up. The recent release of lower than expected consumer price index data has also contributed to Bitcoin's current bullishness. Lower inflation figures tend to boost investor confidence, leading to increased demand for assets like Bitcoin. Overall, the combination of expert analysis, technical indicators, and active market participation paints a promising picture for Bitcoin's future. And that wraps it up. I did also, before I sign off, did want to mention this week's featured post on Bitcoin Fortress Substack entitled Understanding Fiat Currency, a Simple Overview. I have included a link in the show notes and also links to all of the other information that was covered in this episode. So thanks for listening to the podcast. If you enjoyed the show, please like and leave a comment. Also, don't forget to subscribe on your favorite podcast app so you don't miss an episode. You can also follow my Substack at bitcoinfortress.substack.com, and you can follow me on Nostr. My NPub is included in the show notes. And with that, I will talk to y'all next week. Bye-bye.